The U.S. housing market didn't slow down. It hit a wall. Overnight, a 25% tariff slammed into Canadian lumber, and the shockwave tore across the continent. Within hours, America's largest timber company lost half its quarterly profit. Construction sites went quiet. Home prices surged before a single nail was hammered. While Washington celebrated the move as a win for U.S. mills, Ottawa was already reaching for a trillion-dollar weapon that could flip the entire fight on its head, and it's one Washington can't afford to ignore. It all began in early 2025, when the Trump administration reignited a decades-old trade war by slapping a steep 25% tariff on top of existing duties for Canadian softwood lumber. Some shipments now face nearly 40% in total penalties. The White House framed the move as a defense of domestic industry. Canada saw it as economic aggression. And this wasn't a one-off. Other Canadian exports, including select energy products, were hit with a 10% tariff. By late July, Washington tightened the screws further. The U.S. Commerce Department finalized a new anti-dumping duty of 20.56%. Canada was given until August 1st to strike a deal. Commerce Secretary Howard Lutnick said there would be no extensions, arguing that Canada had years to correct the imbalance. Domestic producers like the U.S. Lumber Coalition cheered. They had long claimed Canadian provinces allowed mills to harvest timber on public land below market rates, undercutting U.S. sawmills and triggering closures in logging towns from Oregon to Maine. Ottawa countered that the U.S. was disguising protectionism as fairness. But beneath the rhetoric, Canada's government was weighing an option it hadn't considered in decades: export quotas. Politically risky, but the severity of the American escalation forced it onto the table. The corporate fallout was immediate. Weyerhaeuser's Q2 2025 net earnings dropped from $173 million to $87 million, despite revenues remaining just over $1.9 billion. Management warned Q3 could fall another $60 million. The causes: a housing slowdown triggered by high interest rates, a lumber oversupply depressing prices, and rising input costs as tariffs disrupted supply chains. Rather than retreat, Weyerhaeuser doubled down, buying more timber acreage, expanding high-margin engineered wood lines, and approving a $100 million stock buyback to project investor confidence. Still, its fate was tied to a housing market caught in a pincer grip. Mortgage rates at decade highs and material costs spiking unpredictably. By May, new single-family home sales suffered their steepest drop in nearly 3 years. Builders were facing framing lumber prices that could swing by thousands per project in just weeks. Industry analysts warned the tariffs could add as much as $14,000 to the cost of an average new home by 2027. The National Association of Homebuilders called it a direct threat to affordability. The U.S. Lumber Coalition argued the short-term pain was worth the long-term goal of rebuilding domestic capacity. Neither position was bulletproof. The former downplayed the political demand for protecting industry, while the latter underestimated the economic toll of tightening supply in a high-interest rate environment. Canada, meanwhile, wasn't bluffing about its leverage. International Trade Minister Dominic LeBlanc highlighted that Canadian investors hold around $1 trillion in U.S. assets, growing by $100 billion annually, a reminder that economic interdependence runs both ways. Prime Minister Mark Carney rejected the August 1st deadline, saying Canada would not be pressured into accepting a bad deal. His government took a dual-track approach, exploring export caps as leverage and fast-tracking market diversification. The pivot was swift. In just 1 year, the U.S. share of Canadian softwood lumber exports fell from 78% to 68%. Europe and Asia stepped in, though ocean shipping added costs and required adjustments to different grading standards. The shift signaled Ottawa's willingness to absorb short-term losses to avoid long-term dependence. One development drawing quiet interest in trade circles is how third countries are entering the fray. Japan and South Korea, major importers of Canadian softwood, have shown interest in securing long-term supply agreements at favorable rates. European buyers, especially in Germany and the Netherlands, are negotiating decades-long contracts, effectively reserving supply that once flowed almost entirely to the U.S. This isn't just a lumber story. It's about leverage. Once Canada's long-term deals with Asia and Europe are locked in, even a future U.S. policy reversal may not bring back the old trade flows. Washington may soon find itself competing for access to Canadian timber it once assumed was guaranteed. At the same time, currency fluctuations are deepening the divide. The Canadian dollar's weakness against the U.S. dollar is making Canadian lumber more attractive to global buyers, even when shipping distances are longer. That currency tailwind is narrowing the price gap between Canadian and U.S. suppliers in markets well beyond North America. For U.S. policymakers, the realization might come too late. The tariffs designed to secure supply for American builders could end up pushing Canada's most valuable export relationships permanently offshore. Alongside the tariffs, Washington unveiled a plan to boost U.S. logging by 25% on federal lands, a move pitched as a fix for constrained supply. Forestry economists were blunt. Even if fully implemented, the increase might raise total U.S. lumber supply by less than 1%. Federal timber access is limited, much of it locked behind expensive infrastructure needs or unfit for construction-grade use. Legal challenges from environmental groups were inevitable, likely delaying any tangible supply bump for years. Some U.S. mills, particularly in the South, didn't wait. They invested in automation to maximize output per log, aiming to gain market share, while Canadian imports remained costly. In towns that had lost mills over the past 2 decades, this offered a cautious revival, but housing sector demand was measured in months, not years. Canadian lumber companies took another approach. They bought U.S. mills. Firms like West Fraser and Camphor expanded operations in Georgia, Alabama, and South Carolina. By producing lumber domestically, they bypassed tariffs entirely. U.S. industry groups largely welcomed the capital and jobs, though some American mill owners voiced concern over intensified competition from deep-pocketed Canadian firms now operating within the tariff wall. By midsummer, both countries had adjusted their strategies, but not resolved the core dispute. The last softwood lumber agreement expired in 2015, and without a replacement, there was no mechanism to prevent escalation. Trade experts floated options: multi-year quota agreements under the USMCA framework, joint forestry investment initiatives, or harmonized sustainability standards. Each proposal required political compromises that neither side had been willing to make. But at this point, it's not just a tariff dispute. It's a race. Canada is racing to replace U.S. market share before the housing downturn becomes entrenched. The U.S. is racing to scale domestic supply before homebuilders start canceling projects en masse. Both are moving faster than they can measure the consequences. If history is a guide, the real danger lies in permanent damage being done before any deal is reached. Mills that shut down rarely reopen. Export routes redirected to Asia or Europe often don't return. And homebuyers priced out of the market may never come back. By August, the stalemate had turned into a test of political resolve. Washington was gambling that sustained tariffs would pressure Ottawa into submission. Ottawa was gambling that market diversification and selective economic leverage could hold the line. Both strategies risked underestimating how fast short-term economic pain can harden into long-term structural loss. Beyond the economic impact, the dispute was reshaping political narratives. In Washington, it was portrayed as defending American jobs. In Ottawa, it became about national sovereignty and resisting coercion. In both capitals, leaders faced domestic audiences unwilling to accept any form of backtracking. Meanwhile, the consequences were stacking up. U.S. housing affordability continued to decline. Canadian forestry towns saw shipment volumes drop. Global lumber flows shifted in potentially irreversible ways. What began as a softwood lumber dispute had become a case study in how deeply integrated economies can fracture under political pressure, and how long-standing trade relationships can unravel in a matter of months. Some experts suggested resolution would require accepting once unthinkable compromises. Quotas Canada had long resisted, or tariff suspensions the U.S. had refused to consider. Others saw hope in reframing the issue around shared climate and forestry goals that could support a cooperative supply agreement. For now, neither side is blinking. The U.S. is holding firm on tariffs. Canada is diversifying exports and signaling it has more economic levers to pull. Each side is betting the other will hit the breaking point first. But the outcome won't just determine who supplies two X4S to American homebuilders. It will shape how the U.S. and Canada handle every future trade conflict, from energy and agriculture technology, in an era where trade policy is increasingly weaponized. Even the most familiar supply chains can become battlegrounds overnight. And as the summer heat bakes idle lumberyards and half-framed homes, one truth is becoming unavoidable. Once a market rewires itself under pressure, putting it back together can take far longer than anyone expects.